The leadership of the world's most powerful central bank has just changed hands, and that shift will directly impact your credit card rates, your mortgage, and even the price of groceries at the store. For years, Jerome Powell was the individual behind every major interest rate decision affecting the United States economy and millions of people around the world. But now, a new name is taking that seat at the head of the table, and his name is Kevin Warsh. And before you think this has nothing to do with me, just stay with me for the next 2 minutes, because it absolutely does. Every single decision this person makes determines whether the money you've been saving is worth more or less 1 year from now. That is not an exaggeration. This leadership change happened at a very specific moment. Inflation in the United States is sitting around 4.2%, more than double the government's official target rate. Which means the new Fed chair is stepping into the role right in the middle of a problem that has not been solved yet, and the pressure is already on day one. So who exactly is this person, and what has he already said publicly about what he intends to do with the most important economic lever in the world? Kevin Warsh is not a new face in the world of American economics. He has worked inside the Federal Reserve itself before, which means he knows exactly how this machine operates. And his track record is defined by one consistent characteristic. He tends to be far stricter on inflation control than his predecessor was, which tells us a lot about what comes next. In practice, that means one phrase that nobody wants to hear right now: higher interest rates for longer. That is the direction this new leadership is signaling. Today, the benchmark interest rate in the United States sits between 3.50 and 3.75%, and it has remained unchanged through the last 3 official Fed meetings in a row. Many analysts and investors were expecting a rate cut. It did not happen. And with the new chair now in position, the likelihood of a fast rate cut becomes even smaller than before. Why? Because the number one priority right now is to bring inflation under control, even if that means keeping credit expensive for consumers and businesses alike. And this inflation is not coming from thin air. The single biggest source of upward price pressure right now is energy costs, particularly fuel prices at the pump. Part of this is directly tied to the ongoing conflict in the Middle East, which has been pushing oil prices upward over the past several months and feeding into broader inflation. In other words, the new Fed chair is taking the wheel while dealing with a problem that doesn't depend solely on him. It depends on what happens on the other side of the world. Now, let's get straight to the point, because the real question here is not what Kevin Warsh believes. The real question is, what does this actually change for your money? First, if you are carrying credit card debt right now, the cost of that debt remains high, and there is no clear signal that relief is coming anytime soon. Do not wait it out. Second, if you are thinking about financing a home, mortgage rates are sitting near 6.5%, and they are expected to hold at that level for as long as this current environment persists. Third, if you have money sitting in a high-yield savings account or any account that earns based on the interest rate environment, that return tends to stay relatively attractive. That is the upside of this scenario. Fourth, for anyone in the stock market, higher rates for longer tend to put pressure on companies that depend on cheap credit to grow, and that hits the technology sector particularly hard. And it is no coincidence that in recent weeks we have seen significant drops in stocks tied to artificial intelligence. This is the direct market response to that rate environment. Now you understand why the leadership change at the Fed is not just a political story. It is a direct story about your money, your debt, and your financial decisions going forward. The next official Fed meeting is coming up in June, and that is when the new chair will send his first major signal to the financial markets and to everyone paying attention. There are 3 things that can come out of that meeting, and each one affects your finances in a different way. Let's break them down right now. Scenario 1. The Fed keeps rates exactly where they are. This is the most likely outcome right now, and it simply means more of what you've already been experiencing. Credit stays expensive. No immediate relief. Scenario 2. The Fed signals a potential rate increase if inflation does not come down. This would make borrowing even more expensive, but it could significantly strengthen the US dollar. Scenario 3. The least likely in the short term. The Fed opens the door to a rate cut if inflation starts coming down faster than expected. Possible, but not what the data is showing today. Regardless of which scenario plays out, one thing is certain. The era of historically low interest rates that we saw in previous years is not coming back anytime soon. That chapter has closed. And that is exactly why understanding who leads the Fed and what that person thinks about inflation and rates is not just political curiosity. It is basic financial planning. In the next videos of this series, I will go deeper into exactly how these decisions impact your credit card bill, your mortgage payment, and what moves make sense depending on which scenario actually plays out. If this video helped you understand what is actually happening, hit the like button. It genuinely helps this channel reach more people who need to hear this kind of clear, honest breakdown. And in the comments, tell me, are you actually feeling the impact of high interest rates in your daily life? Credit card, car loan, mortgage, savings account. I read every comment. Subscribe to this channel because as new decisions come out of the Fed, this series will be updated with new videos and new scenarios analyzed the same clear way. Next video, what this Fed decision truly means for your credit card and your mortgage, with real numbers, real scenarios, and what you can actually do about it. See you there.